Morning. Happy day today. It is actually a wonderful day because today I'm going to get my second vaccine. I'm doing the Moderna vaccine. Have you done your vaccine yet? Or are you going to do your vaccine? If you are, give me a comment, let me know, and also where you're watching from. So, this is Louis Llanes, and I have this show called Market Coffee Talk. It's going to be converted to a podcast. We're also going to be adding guests to it. We're in the middle of programming and putting that all together. So I think I'm on episode 50 actually today. So we're kind of getting off to a running start. And I talk about lots of different things. I talk about what's going on in the market sometimes and investment strategy. And sometimes I talk about just personal development things that I find interesting, things I'm reading. Sometimes we'll talk about things in the news and really want to try to make it as interesting as possible for you. And we're going to have some amazing guests that are going to be making this a lot more interesting for a broader audience. And it will also be put into a podcast. So we're in the process. We actually just hired a new person at my firm who is going to be working on all these projects that we're doing to get them launched and off to a great start. Now, normally what I do is I have a little bit of coffee. And actually what I'm doing now is I'm kind of blending them together with this orange stuff, which is Emergen-C, because I'm about to take the second Moderna shot. And actually quite a few people that I know that have taken this have had some symptoms, have not felt too hot after they've had that second shot. One of my employees has a fever over 100 right now. She just had hers yesterday, and she's not doing a whole lot of work. Another person I know has got a lot of brain fog. So I'm prepared for that. But today I want to talk about horse races and why horse races could be a great thing to think about when you're thinking about putting money in the stock market. A lot of people have really think about their stock investments in a way where they think, oh, what does the company do and all that. And all of that is really, really important. We can talk a lot about fundamentals. But today what I'm going to talk about is some tactical strategies that can help you get better performance if you trade your own stocks. And I have a proprietary account that I trade where I get very concentrated in certain stocks. I have other accounts that are more, more broad. But if you're looking to make money in the market and you want to be aggressive, this is something to think about. It's not for everybody. I'm not making a recommendation, but I want to explain to you a philosophy that helps people make bigger returns in the equity markets or in any market versus just buying and holding or diversifying them up. So what I'm going to do is I'm going to actually share my screen with you, and I want you to see this. I've got a little chart here. In this chart, I've got some stocks that I do own now. So in full disclosure, I own these stocks. And these stocks, if you think about when you initially buy them, you can actually increase or decrease the size of your investment depending on how the stock is doing. And what this will do is it'll allow you to have bigger returns if you follow the trend in a way that will give you more position in those that are doing well and less position in those that are not doing well. So imagine buying 10 stocks, one in each sector, right? So if you had 10 stocks and you found the very best stocks that have the best fundamentals and are technically set up just right, where there's a volatility contraction pattern. So volatility is declining and you're buying it when volatility is low, because that's one of the things that's a little secret that a lot of people don't know, that many times before a stock actually takes off and moves higher, volatility will tend to decline. It'll tend to get tighter and tighter and tighter, and then you'll have this enormous push move higher. So if you have a company that has great fundamentals and it's starting to go into a volatility contraction type of a pattern, you can buy them as they're emerging from what's called a base. And that base will allow you, that it starts to move higher, that will allow you to time your entry better. And once you've done that, let's say you've got 10 of them that are on, and these are actually 11 stocks that I actually own right now. They're not recommendations, but let me just show you as an example. So if you take a size that's relatively equal, right, in each one of these stocks initially, as you time them in, as you take your position, you can break them up, and you could start by taking an initial position of, say, 1/2 of your full size. So whatever your maximum position size that you'll have in a particular investment, you would have about 1/2 of it on. Now, as the stock progresses, you can have thresholds like a horse race. So you're looking at it, you're saying, look, I think all of you guys have equal potential to do well, and I'm going to let the market tell me what I should buy more of, and the market tell me what I should pare back from. So imagine this pie that can be dynamic, right? Your capital can be dynamic depending on what the stock is doing. So in this case, what we see the top performing stock here up 23%. That particular stock actually happens to be, if you look at this, it happens to be United Therapeutics, right? And then, so as that stock has started to emerge, you add more to it. And instead of just putting all your money in, you scale your way in. Say you take half a position in, and the stocks that perform the best, you have specific buy points that if it's starting to move up, you buy more of it. And then if it starts moving down, you scale back a little bit, and you use the capital. Whatever is not doing the best is where you use that capital to fund the additional buys to the stocks that are performing well. So like today, I sold a Zion Bank, because Zion Bank, if you look at the last 5 days, Zion actually, you can see in this black chart right down here, Zion started selling off. And they even had great blowout. They had great earnings, and the stock still went down. So even though you have a great company, the timing may be amiss. So you want to go where you're making money, and what has been doing well. You can see up here, we had a big pop in Lauderdale-Bacel. I always have a hard time pronouncing that. So we've added to other names, right? LRCX, Lam Research, was added to, right? Because that particular stock is starting to do better and performing well, breaking out. Magna International, MGA, started doing better. Sprouts Farmers Market started doing better. So basically selling Zion to recycle that capital to more productive assets, selling UHAL, for example, to an LYB to buy more of these other stocks that are doing well. And that's really a trick. It's so simple, and it's not a holy grail, but what it does is it keeps you from maybe having not focusing your capital in the best place. And this is only for aggressive investors. So the best thing to do is to set up your capital in a way where you can get concentrated in, say, 5 names to 10 names. And you're really looking in this account to be aggressive, to make money in it. And you can have some of these stocks do exceptionally well. And you can get whipped around a little bit. You might have some moving up and down, and then you will be not actually clear on your positioning. But over time, what will happen is you will have your clear winners will start breaking away, and you will have focused capital in those clear winners. And then once you have those clear winners in there, you're always looking for me, I like to look every week to see what stocks are setting up to look well. So I'll always change my watch list every week in this particular type of trading account that I have for myself to actually see if there's any new stocks that should be added to that watch list. Sometimes there may be stocks in different sectors that will come up and it'll change. So like, for example, this list is one stock, like my favorite, like right now, stocks that are in each sector. So, and I like having a blend of sectors so that I'm not focused in on one area, right? So, and sometimes a certain sector will get really interesting, and we'll buy more in that sector. But I usually, in this account, I won't buy more than, say, 2, maybe 3 stocks in a particular sector or group. But the idea is think of it like a horse race. As time goes on, and then you have a clear winner, you let the market tell you who the clear winners are. And as that is happening, you get concentrated in that investment. And what you do after that is you want to trail those stocks so that you let it keep going up. As long as the trend continues, you let it keep going up and you trail underneath it. So if it starts giving some back, you might pull some off. And if another reason why you would want to pull some off would be if you have a stock that's size is getting so big in your account because it's growing so much that it is having too much of an overall impact on your results. That's a whole nother discussion, the ongoing trading size once you get going. I'm talking about right out of the gate when you start, how you can adjust your capital so that you're getting concentrated in the winners. And then over time, then there's a whole nother really dynamic to that because you have new blood coming in, new investments that are looking attractive, and then you have to manage your existing stuff that you have, existing investments. And as the relative attractiveness of these investments change, you change your position size. So if something new comes up and you've got some stocks that are just too big as a percentage of your overall capital, you would trim on those and then recycle that money into the other ones. It's kind of like a rebalancing. So this is a tip that I think if you're one of those types of people that likes to do it yourself, we generally, and if you're aggressive, this is something that most clients don't do this because this is not what their goal is. Their goal isn't to make tremendous amounts of money in the markets. They're usually trying to preserve because most of our clients are already wealthy. They have $1 million or more to invest, and they're really trying to get a reasonable rate of return without sticking their neck out. But if you're a younger person and you're really trying, or if you're not a younger person, but you just want to have some of your capital in a strategy that allows you to really concentrate and really try to make money, this is a great way to think about it. Think of it like a horse race. Think about it. They're coming out of the gate. You're trying to figure out which ones you're going to get big on, but you don't want to get big on them based on what you think should happen. You get big on them based on what is actually happening, and you reduce those that are not doing as well. This is such a simple concept that I think a lot of people just kind of don't do it. They don't do it because they think it's just doesn't make sense, and it can't be that easy. And it isn't easy because there's times when you get going and the markets get rocky. So let's talk about the other side of the equation, losing money, because part of investing is losing money, and it's just the way it is. The key is that your average win times the probability of winning must be a much bigger number than your average loss and the probability of losing. So the best investor traders in the stock market generally have hit rates, meaning for every 10 stocks or 100 stocks. Let's use it for every 100 stocks that they invest in or trade in. Usually 50 to 60 of them will do well. So 50 to 60%. And then they'll lose money literally on, I've seen some really great traders, amazing traders that lose on 70% of their trades, but they make a lot on the ones that they win in. And that's the real key. The key is to let your winners run and then to cut your losers short. So part of this equation is scaling down. So for example, Zion Banks is cut in half, and that particular stock got cut in half in position size, not in value, but in how much we put into it. But it could go down. If it goes down more, it will literally be out of it and it will be replaced. I have a phone that's going off the hook. So let me go grab that real quick. Sorry about that. Sorry. That was my reminder to make sure I get ready for my next meeting. But anyhow, so what were we talking about? Oh, we were talking about once you get going on that, you're going to have some that are going to be losers, and the key is to keep that loss small. So if you look at the volatility of stocks, it really is related to your time horizon. If your time horizon is longer term, then you're going to take smaller position sizes, own more stocks, but you're going to take on more systematic risk, which means general market risk. The key is in this type of a strategy is to not take on a ton of systematic overall market risk. You're going to give them a shorter leash because your position sizes are larger. It's not like buying a mutual fund. This is about making money, which means you must concentrate. It's not for everybody, but for those aggressive investors that really want to hit the ball, this is the kind of thing that you have to do. You must concentrate. And if you want to learn more of this type of thing, I would say probably the best sources on this would be Mark Minervini, and then definitely William O'Neill's work with the Investors Business Daily. What I do is not exactly like what they do, but I've learned some of these concepts years ago from them. And from experience, you develop your own style. But there's certain things that are kind of non-negotiable. And one of the things that's a non-negotiable has to be cutting your losses short. You cannot you can't just hold them. If you're going to have big position sizes, you cannot just hold them if they start losing money. If they lose 50% of your value and you've got a huge position size, your investment portfolio has to go up 50%, or that stock has to go up 100% just to break even. If it goes down 50%, you got to go up 100% just to break even, which is not always easy to do. So the key is usually to keep that within the volatility range. And from a lot of backtesting quantitative analysis, our data that we've looked at tons of data and looked at it many, many different times, shows that you need to have at least like 5 days of trading volatility that you're looking at. So, so as far as a multiple, there's many different ways to look at it. But most stocks that are winners, when we did an analysis that said, okay, of the stocks that you bought that were winners, what was the worst that they did before they went into profit, right? So how much room do I need to give a stock before? And we found some very interesting data on that. But most stocks that are winners do not go down a lot. What will happen is they'll come down, but then they'll bounce back up right away. And so the more a stock starts heading down, the more your probability is that it's going to be a clunker, and it could be a clunker for a long time. So you just have to keep that in mind. And the other thing has to do with letting your profits run. That's another like non-negotiable. And letting your profits run really requires you. It really requires you to have patience and to let the stock breathe, because as it goes on, you want to give it more room. So you'll see your fluctuations go up and down more. But I can think of many stocks that I did not give enough room and had too tight of a leash once I got into a good profit situation. You have to be sure that you let those go. So you want to let your profits run, but you also want to nail some profits down along the way as you're going. So a lot of times you like to if you have a really big winner, you can pull your capital out of it and let the rest of it run, and let it run for a long time as long as you possibly can, because that's where the real money is made, is in letting these winners work themselves out. We have these great companies that do well, and they continue to do well. But you want to protect your capital as you're letting them out of the gate. That's another big key part of the strategy if you're really trying to make money in the markets. Anyway, that's all for now. I'm getting ready to go. I'm going to go to a meeting, and then I'm going to have a shot. So I hope you're doing well. This was relatively technical topic, but for those of you who are inclined to try to make real money, like larger returns, knowing that it's risky, right? But that's what you want to do, or with a portion of your capital, and you want to do it yourself, here's a few tips for you. Hope you're doing well, and we will talk to you later.